Tonight is going to be a very short one. Just explain two other terminologies that we'll be using, and we'll be discussing the nature of price action. Right? If you remember, we discussed Euro AUD. Right? We discussed Euro AUD, and one of the things we said is that most retail traders try to predict with some level of assurance where price will turn. And we said with this strategy, we don't try to predict where price will turn from. We just flow with price. Like something interesting happened today with USD CHF. Something happened interesting today with UCHF. Right? UCHF has been on, downward trend. For trend line traders or support and resistance traders, this was a good place for it to turn. It actually started creating, giving that impression that it was reversing right about here. And what happened thereafter? It broke through that support and would have raided a lot of SL. And it doesn't look like it was going to stop. It did play around a little here, and later today, down, right? So with this strategy, we don't try to predict where price will turn. We actually wait for it to begin its move, and we go along with it. So you lose like maybe once or twice, but notice would have been in a sell right about here. If we mark this up based on what we've learned in the past, this was the highest point. And prior to that time, we had this low, this sell that gave us this high. Then we had this sell that gave us that high. Then we have this sell that gave us that high. So this was going to be like, let's just pick one of these. This sell here, downward candle as our source, which was broken. It was broken right about here, right? Price broke through it, and once price breaks through an order block, I beg your pardon, once price breaks through an order block, it becomes a breaker, right? And the highest candle at that point becomes our source. Now we're waiting for price to either retest. This is on 4 hours. So we have to wait for like almost a day or two to be sure that the order flow is now bearish. Then what we simply do is trade in line with the order flow. We don't try to force the market to buy. For this case, we just sell. We just go into a sell, right? So price came, tested back the breaker, didn't really get to the source, and dropped. And what do we do after then? We mark out the last up candle before the fall, right? So in that case, we could have this last up candle here, the last bullish candle that created this low here becomes our order block. Price trades back into it to retest it. And what do? We sell straight up, down, right? We have this other bullish candle just about here. So let me just move this. We have this bullish candle here that looks like a bearish pin bar. That was the last bullish candle responsible for this low. And price traded back into it and dropped, right? And that's how we continue. The last bullish candle, price traded into it, dropped. Last bullish candle here, responsible, the last bullish candle, responsible for this low. Price trades back into it. This trade back, watch out the first and second video. The trade back is just a pullback. So why should I be interested in taking a pullback when I could enjoy the whole of this move, right? Price traded back, you know, a retracement, a pullback, a correction, whatever name you want to give it, and after then it dropped and dropped lower. Then this bullish candle became our next point of reference. If price had traded back into this order block, we would have been looking for sell opportunities on the 15 minutes. Remember, we said our entries on the 15 minutes, we've not got to that point yet. Perhaps in the next class or the one after the next, we'll get to our entry. For now, we're just trying to cement the idea, right? So from last week, people tried buying from this point, and they did make some pips. The price rejected and went up, but as institutional order flow traders, we wouldn't have been buying until price breaks this. So let's do something. Take this out of the way. If we have this, say we don't know what has happened so far, and we saw this push down, we'll be waiting for price to retest this order block and we now look for opportunities to sell off the 15 minutes. But remember, if price had broken this particular order block, it's possible we could have lost the trade if we had a setup on the 15 minutes, and most times we wouldn't even have a setup because our setup criteria will not have been met. But for now, we'll just be waiting for a retest or a break, right? So let's see what then would have happened. Sorry. Now, so price came back, retested, right, and sold off straight up from that point, right? It sold off. Now, if price had broken above this point, broken above the order block, then our bias would have changed and we will now be looking for buy opportunities. We don't predict with some level of certainty that because price had bounced off this area before, then automatically it must bounce off. Now, this is what majority of retail traders do. This is what is, almost everywhere on the internet. Yet 90% of traders, retail traders, well, I don't know how they got those parameters, but it's there. Some brokers are mandated rather to say what percentage of their customers or clients make money, right? So majority of retail traders lose money using this same strategy, trying to predict. And most times, because we are not emotionally matured, our psychology is not yet developed in terms of trading, they hold on to these trades, hoping that it will soon turn back, and the account get blown. Using this strategy, we only trade in the direction of the dominant trend, right? So we would have been looking for buy opportunities, for sell opportunities, not buy, right? Notice how price dropped right the way down after I retested that point, and up till now, price is still dropping. Price has violated that support and has refused to go up, right? So it's not in our place to predict what price will do. We just follow price action. Right? Same thing happened with EA and EU, I guess. Watch our previous video. That was the highest point as at the previous video, and we said we're not interested in the sales. We're hoping for price to come back here and give us an opportunity to buy. We'll discuss that maybe in the next class. So let's move on to straight up to what we have for today. Just two concepts to discuss, and we'll leave the remaining for the next class. And the concepts we want to discuss today are points of liquidity in the market. Points of liquidity in the market. Believe it or not, the market is structured in such a way that it makes people want to place their stop loss or their take profit somewhere. So we are retail traders. If we're to sell from this point here, Let me have a clean chart. If we're to sell from point X, right, our stop loss will most likely have been somewhere here, right? That line, because that was the previous swing high, right? The market sees this as a draw, it sees this as a point where several persons have either their stop loss or their buy stops sitting, and it will want to come and violate that place, take out liquidity from that particular point. Now, so there are certain areas in the market where funds are, found, and we call those points of liquidity. An easier way to explain it based on how we would apply it to this strategy. There are several ways of explaining it, but we're particular about how to use it for this strategy is the yesterday high and yesterday low concept, right? But before I go into yesterday high, yesterday low concept, I'll go to the daily time frame, and I want you to see how price behaves. Price has a nature, it has a way it behaves, and I'm talking about price action now. And let's just see how it does. I'm going to use EA for now. We might look at one or two other pairs. Right? Notice when price decided to go back upwards. This is a daily candle. Notice how when price decided to make its way upwards. Sorry. Notice that price was on a bullish move, but it always did something before going back up. It will come back, trade lower than the high of yesterday, violate the high of yesterday, then go up. Next day, violates the high of yesterday. When I say violate, I mean it trades beneath the high of yesterday, then goes up. Does it always happen? Well, nothing always happens in Forex. And that's why you need a winning edge. What happens most of the time? The next day didn't really trade lower, just went up. But that might mean we didn't have a setup for this day. And any strategy that makes you trade every day might just be leading you to blowing your account. As traders, we need to be patient to wait for what we understand or what we seem to understand before pulling the trigger. Now, what did the next candle do? Traded beneath the high and the close of yesterday, then went up. Same thing, traded beneath the high and the close, went up. Traded beneath the high and the close and went up. Traded beneath the high and the close and went up. Same thing here, traded beneath the high and the close and went up. So somebody could just look at this and design another trading strategy of this. That when I see 2 or 3 bullish candles, I will just wait for price to trade beneath the close of yesterday, wait for some signals, and enter to go long. But that's not what we're discussing. I'm just trying to explain the nature of price action, right? Same thing for when we're coming down. Notice, traded above the low and the close of yesterday, then came down. Traded above the low and the close of yesterday, then traded down. This was like a pullback. Well, let's take this to be an abnormality. Same thing happened. We can just pick up any pair and see this happening. Let's see EU, for instance. Right? You can find this virtually everywhere. Let's look at EU from another broker. Let's seek EU from another broker, forex.com. Right, so on its way down, traded above, came down, traded up, came down, traded up, came down, traded up, came down, traded up, came down. You could just see that sequence. On its way down, it doesn't just come up, it doesn't just go down straight up. It goes back into the high, into the close for a low, for a downtrend, It goes in, it violates the close and the low of the previous day before coming down. Violates the low and the close of the previous day before coming down. On its way up, it violates the high and the low of the previous day before pushing. Violates the close of the previous day, push up. Violates the close of the previous day, then pushes up. Didn't happen here, but it did happen here. Violates the close of the previous day and then push up. So if I miss a trade here, I could practically just wait for the close, wait for price to trade beneath the close of the previous day, then I look for my entry to go long. Will I win all of the time? No. Will I win most of the time? Yes, especially if I'm patient enough to wait for this bullish momentum to have been developed. And that is why we trade basically on the 4 hours, waiting for the momentum to have come up before we go in. Now, this trading beneath the low of yesterday are the retracements we see here in red, right? In the red candle. Those are the pullbacks. Those are the corrections. And we're not bothered about them because we know that is not the real trend of the market. Or at least we assume that is not the real trend of the market. And we trade in line with what we see. We do lose sometimes. Sometimes we even have losing streaks. But at the end of the day, we grow accounts and we take our own share out of the market. So that's the concept of how price behaves. Now we'll be streamlining it to yesterday high and low. I'll be adding an indicator here on Trading View, and it's called the high and low indicator. It works best if you go to the 15 minutes. It works best if you go to the 15 minutes, and let's go back to EA. Let's go back to EA and back to 4 hours. And here we can see that the uptrend actually started on the 19th of February, but let's go to 20th of February. So 15 minutes, we'll be going to the 20th of February. Right. So we'll go to the 20th of February. Now, maybe I should explain this clearly before we proceed. The dotted line, and I also want to add session breaks, so we could know when the day starts. So this is the beginning of a new day. We are presently in 20th of February. This dotted line here on the 20th of February is actually delineating the highest point yesterday. And the dotted line here on the 20th of February shows the lowest point the previous day. So this was the highest point the previous day, and this was the lowest point the previous day. And it throws that line into the next day. So the lowest point, for instance, on this particular day happens to be here. Right? If we pull this, go forward just a little, you notice that coincides with the dotted line of the next day, right about here. So just to help us to understand that. Now notice how this was the beginning of the bullish move, but the next day, notice how price retraced in the Asian session and then shot back up, right? It made this high here. Notice how it retraced even into the following day, then shot back up. Notice how it came and took out yesterday's high and went up. Same thing, took out yesterday's high, went up. Took out yesterday's high, went up. You could just see it over and over in the market. Now, I believe you're excited about this strategy and what you can do with this strategy, right? Now, on its way down, exactly the same thing too. So on its way up, it takes out yesterday's high, then moves up. On its way down, it takes out, let's go to UCHEF. Let's see UCHEF to explain. Let's see UCHEF to explain the downward move. All right, let me take out, hide all the drawings. Very good. So on the 4 hours, the downward move actually started. Right. So the downward move started on the 20th of February. We might be interested in seeing, let's start from 20th of February to 21st of February, as the case may be. So 15 minutes. I'll go straight up to the 20th of February. Right. Very good. So we are in the 20th of February. This was the high of the previous day. Notice how price went, took out the high of the previous day, and then ran away. Right. Notice how it came back the next day, barely took out the high of the previous day here. No. It didn't take out the high of the previous day. It just went straightway down. So we might not have an entry for this particular day, right? We might not have an entry for that day. Sorry, I'm mixing up things. For a downtrend, it takes out the low of the previous day, then drops. For an uptrend, it takes out the high and drop, right? So notice the next day opens above the low, drop. Notice how it goes above the low of the next day, right? Trades back as a form of retracement because it's a downward trend. It will retrace a little above the low of the previous day and then make its way down, right? We can see that happening over and over. This was the lowest point as of yesterday, but price starting from yesterday traded above it, played around, but is in a downward trend. And what happened? It still went back down. Traded above, where was it going to? Down. Traded above yesterday's low, down. Traded above yesterday's low, down. Traded above yesterday's low, down. What we want to be catching is this down move, because we've established on the H4 that we are in a bearish territory, right? So we're not interested in the buys because we don't know how far the retracement will be. There are several tools out there that try to promise you that you could predict with some level of certainty using Fibonacci retracement, Elliott waves, and so many things that are difficult and cumbersome to understand, right? But what we're trying to do here is just understand the nature of price, right? This was the lowest point yesterday. Price traded above it, then dropped. The lowest point yesterday, price traded above it because we're in a downward trend. This was the lowest point yesterday. So price traded above it, then dropped, right? Price traded above it and dropped. Remember, this is in agreement with what we saw on the daily time frame, that when price is coming down, it doesn't just continue to come down straight up like that. Several times it trades back up, which we call a retracement, take out the low of the previous day and then drops. Now, retail traders are always itchy to trade. So when it's making this move up, we call it the vector move, the false move, right? It deceives retail traders that we're going long, then all of a sudden it rates them. Hey, we're going long, then it rates. Hey, we're going long and it rates. Same thing for when it is going up. Here, this is the bullish candle. It first trades down. You can see the small wick there. Perhaps I should magnify this a little bit further. Notice how it traded beneath the close of yesterday. Traded beneath the close of yesterday and shot up, right? Towards the end of the session, it began to retrace down and traded beneath the high of yesterday and even traded beneath the close of yesterday. However, its direction was up, right? It opened before this day ended. It began to retrace, traded beneath the high. The following day, traded beneath the close, then shot up. Began to retrace, traded beneath the high. Then the next day, traded beneath the low, and then went down. These were 2 full days of retracement, then shot back up. And we are saying we are not bothered about these pullbacks. There are no formulas as far as I'm concerned that can be used to determine how deep this retracement will be. The retracement here are this week, the up week and the down week. They are the retracements put together. So price trades up, begins to retrace maybe towards the end of New York, continues the retracement perhaps. Who knows? It could have gone up before coming down. We don't know. This is a whole day candle. But the point is that it will first come to take out the liquidity at the top and at the close, right? So imagine if you could have an indicator or have a way of marking up the low, the high, in the case of a bullish momentum, the high and the close of your candles. And you've established on the 4 hours that this is a bullish momentum. Imagine if you could find a way of marking this up, and once price trades beneath both lines, then you begin to look for reasons to buy on the 15 minutes. Either you're looking for a divergence or something to give you an indication to buy. Notice how profitable would have been. We might have lost on 1 or 2 occasions, but notice how profitable would have been if we do our position sizing properly. So basically, that's what this strategy is all about. So if you don't understand what I explained, I will enjoy you to watch this video again over and over until you get a hang of it. I'll be doing the 4th part. I promise we're going to discuss 2 things, but it's looking like we'll only have time to discuss 1. So I'll quickly go through this again. Liquidity points based on this strategy can be found at the highs and the lows of yesterday. Let's go to MT4. This is 15. Let's go to 15 minutes chart here. So I have this on my chart here, right? I have this indicator that shows me the high of yesterday, right? So this Friday, this was the high of Thursday here, and this point here happens to be the high, the low of Thursday, right? So if I'm in a downward trend, let's go back to let's take EU for instance. Let's take EU for instance, right? So on our 4 hours, we would have established that EU was, moving upwards. If you're in my Telegram group, I'll drop the link at the end of this video, and I'll also drop the link to the previous videos, part 1 and 2. If you're in my Telegram group, we said until price breaks this point here, which was our last order block responsible for this high, until price breaks it, we are not selling EU, right? Several persons thought, oh, it has gotten to its highest point, is on its way down. Watch part 1 or part 2 of this video. We anticipated that price may get to this point here, and price just did that today. Price just got to this point, right? And even though price had gotten to this point, we're still not hoping to sell the Euro USD until price action itself tells us that the bullish momentum is exhausted, right? I know some other persons have other ways using COT, Commission of Traders, only like, well, we are retail traders, we don't know all of those things, but we will trade what price tells us. Imagine if we had gone long today upon a retest, because what we said is price breaks, retest. Price came to do a retest twice. The first time it gave us 108 pips, and of course, just today again, price offered us 136 pips. Would we have caught all of it? Maybe. if you're a genius, if you're an expert, or if you're a guru, I know I wouldn't have got the whole 160 something, but I would have taken something off the table once it got to the high, once it got to the previous high. Remember, if it's an upward trend, then we assume that it's supposed to have a higher high. So we're expecting to have a high beyond the previous high, which happens to be this high here, right? Where the cursor is. Now, so let's go back to the 15 minutes. We've established that from the 18th or 21st of February, EU was practically in an upward trend, right? So you missed this, for instance. How would you catch the remaining? You just wait for a day. So let's go back to 28th of February. Yeah, so we're here now. Somewhere around here. So what we'll be looking for is that we'll be waiting for price to trade beneath the high. There are some days price will not trade beneath the previous day's high. It will just proceed and go straight forward. It means we are not trading EU that day. We might have a setup in another pair, right? But as it is now, we'll wait for price to trade beneath. Notice how price went up, created a high, then the rest of the day it did that pullback I explained on the daily, played around a little, but we are more interested in the push up because this is a bullish flow. So we'll be waiting for opportunities to go long. What criteria would we want to see? We'll explain that when we get to our entry techniques. But for now, we're just explaining the concept, right? Notice how price traded beneath the high of the previous day, which is this white line. This white line is the high of the previous day. This happens to be Wednesday. So price traded beneath the high of Tuesday and went up. Price on this particular day traded beneath the high of Wednesday and price went up. Price traded beneath the high of Friday and of Thursday and price traded up. Price traded beneath the high of Friday and it rallied. Notice how it repeats that over and over and over again. Pick any pair of your choice after this video and do exactly what I just showed you. If you like using TradingView, you can get this indicator, high and low indicator. I have it right about here. The high and lows, LD3K, 46 likes. That's the indicator here for TradingView, right? So when we get to the last video where we discuss our entries, I'll tell you how you could get the indicator for MT4. Thank you for coming online. Please don't forget to